Hi stock investors, JJ here. Welcome back. Well, today I'm going to react to this video with Aswath Damodaran, the Dean of Valuation. I've been following what he's been saying over the past few months on the other channel, The Art of Value. If you want to check out the videos there, this is a new channel. Do subscribe if you want to, but let's see what Aswath Damodaran's got to say about the Mag 7. Have they become the value stocks of the market? I think that's not probably the right headline for what he's saying, but let's have a look.
He's the president of finance at NYU's Stern School of Business. Welcome back. It's nice to see you.
Thank you for having me.
I feel like, it's becoming a bit of a broken record. I mean, we have you on. Tech stocks go up. NASDAQ extends its record high. And I ask you the same questions because they're the only questions that really seem to matter.
Right.
So he's been fairly bearish, saying that the market's overvalued. Nvidia is insanely valued, he said. So what's he saying now? Has he changed his tune a little bit or not? He does own Nvidia, by the way, and some of these Mag 7 stocks, I think. And of course, Tesla's gone up about 40% over the past month.
Right now. But your answers might have changed because the stocks continue to go up and the valuations theoretically are getting more extended. How do you answer it now?
It's a bit like Groundhog Day. You're absolutely right. We talk about the same issues over and over. But collectively, these 7 stocks have had, it's not just the last 6 months. If you look at the last year and a half, they've added $8.8 trillion in market cap, just these 7 companies. Just to give you perspective, the second largest market in the world, China, is a market cap of $12.1 trillion. These 7 stocks alone have added more in market cap than the entire German market, the French market, the Swiss market. It's been an...
Wow. Did you catch that? That these 7 Mag 7 stocks have added more in market cap than some of the biggest stock markets overall, the whole, what they're all worth, not together, but what they're all worth just in the past year. It's been an incredible run.
Astonishing run. But I would also argue that before we dismiss these as risky tech companies, these are the money machines in this market. So when Jeremy Siegel talked about value stocks, I think in many ways, these have become the value stocks for investors who care about earnings and cash flows, because these are the companies that are delivering those earnings and cash flows.
There certainly are value investors, big like super investors, fund managers who own these stocks, the Googles, the Amazons, the Microsoft. Certainly there's some owners there from value investors, but the multiples are definitely extended from where they were. If you think of Warren Buffett buying Apple at a P ratio of 11 or 12, hard to believe, isn't it, back in 2016 and it maybe even 2017 when it was creeping up a bit. But if you look at them now, it's quite different back then.
Wow. So you don't necessarily think that we're in any kind of danger zone in terms of valuation here?
If you look at that, the tech sector valuation forward PE ratio 29.7 right now. 20-year average is 17, so that's quite an elevated level there compared to the average over history over 20 years.
Now, if we're in danger zone, it's not just the 7 stocks are in the danger zone of tech stocks, it's a market overall. I compute a monthly market equity risk premium. It's my personal indicator of how hot or cold the market is. Start of July,
okay, hot or cold. So Howard Marks also, again on the other channel on The Art of Value, I did recently an interview with Howard Marks, and I'll put a link to that channel in the description, where he talked about taking the temperature of the market. He's written a book about that, about mastering the market cycle, not predicting what's going to happen, but just taking the temperature of the environment, of the market environment at any one time. And there we see Aswath Damodaran saying that the same thing, taking the temperature of the market.
Equity risk premium, the implied equity risk premium for the market is 4.11%. That's the lowest number it's been since September of 2008. In other words, it's almost as if the market has raised the last 15 years, and we're looking at numbers very much like what they used to be before the big crisis, the 2008 crisis. Now, the question we can ask is the market overreaching on that assumption? But a 4% T-bond rate and a 4.11% equity risk premium is 2005, 2006 numbers, not 2018 or 2019 numbers.
Does that tell you that we might be heading into a certain place we need to be aware of?
Yeah, I think we need to be careful. I think 4%.
He says we need to be careful. So, that period that he was talking about, remember, was leading up to the great financial crisis, the global financial crisis there before that, where it was really the housing market. There wasn't a market bubble back then. It wasn't like the tech bubble. It was different. It was more focused on the housing market. But of course, there were markets involved there, as we, saw, if you see the movie The Big Short, it goes through what was involved there with the investment banks and the financial markets.
To me is a red flag, at least from the numbers I've looked at historically. Once equity risk premiums drop below 4%, it's almost like a magnet pulling them back towards a 4%. So I'm going to track that number, and I track it at the start of every month. And at the moment, I think we're getting to a point where even pre-2008 status, you'd say this market is reaching a zone where you might need a correction to clean it up again.
All right, so he's saying it's getting elevated and it needs a correction. Remembering a correction isn't necessarily a crash. A correction of 10%, that's considered a correction. If we go down to 20-25%, that's getting to bear market territory. But what's a correction? I think he's probably just saying 10%, which wouldn't really be that much at this point, considering what's been going on with these Mag 7. Different for the whole market, these underlying stocks, but that's interesting. He thinks things are running a bit hot.
I think what's interesting is you also make the point that the market is not being driven by rate cut expectations. Now, I'll grant you that, because it feels like we've recently, anyway, stopped obsessing over the Fed. However,
I've been saying that too. I've been saying that the market, it did get a shock when rates started to go up. They went up really quickly. Inflation took off, and then the market kind of got used to elevated rates. Rates were emergency rates for many, many years, and now, even though they've gone up, they're not above average historically. They're not. They're just, kind of average, and the market seems to be getting used to it. And, I'm not sure. Well, we'll have to see what happens with rate cuts for the rest of the year. It was at the beginning of the year, people were saying 6 rate cuts before the end of the year. Now it's looking like 1, maybe 2.
However,
actually, I'm going to react to a video with Jeremy Siegel talking about that. He's calling for rate cuts really soon, given he can see deteriorating things in the economy right now, as of right now today. So I'm going to react to that video next.
Today we're thinking about it again because we got the jobs report. The Fed chair himself is on the Hill for 2 days next week, and we're going to have more inflation data coming down the pike in the next handful of days or so. And we're going to start thinking about rate cut expectations. And I think at this point, there's a pretty good expectation, and it shows in the market futures itself, of September, December cuts coming. So we must be pricing it in at least a little bit.
From September, first rate cut from September now saying, but could be later.
Let me suggest an alternative, a narrative, which is, let's say rate cuts happen. The Fed cuts rates in September, December. But let's say U.S. Treasury rates, especially at the long end, don't change very much. In a sense, the market's saying the rate cuts happened. T-bill rates, the short end of the Treasuries might be affected. But my point is that the market seems to be going up in spite of rate cuts not happening. It's almost as if the market has decided there's a different narrative driving it. And I think the closer we get to November, I think the less rate cuts are going to be the issue, and more the issue is going to be what's going to happen on tariffs and taxes, which are going to be driven by what happens in the election.
Okay, so what he's saying there is that, the market's getting used to rate cuts, getting used to rates the way they are, and inflation is, coming down. It's come down. It seems to be okay. So other concerns, if the market climbs the wall of worry, which it has been doing, maybe there'll be other worries, and we've got the election coming up, of course. So, and that's been playing on the market with perhaps Biden possibly, being replaced, that sort of thing. So, maybe the concerns will change. What do you think? Let me know in the comments what you think about all this. Do you think the market's going to keep climbing? Do you think Aswath Damodaran's correct here? Now, this is the new channel, so if you want to subscribe to get more of this kind of content, and there'll be a lot more of this, do subscribe. and hit that notification bell to get notified when I post new videos, which will be pretty regular. And I'll put a subscribe button on the screen at the end here, and also a link to a video that YouTube thinks that you should watch next. It might be one of mine, it might not be one of mine, and that's fine. So go and see that now if you want to, and I'll see you in the next one.